For this week's Smith Business Close-Up, we're on location at the University of Maryland, where we are joined by Mike Faulkender, who is an associate professor of finance and director of the master's program in finance at the University of Maryland's Robert H. Smith School of Business. Professor, thank you for being with us.
Thank you for having me.
We want to focus in on this issue of U.S. companies and their overseas earnings and the taxes on that. And let's start with an example, because Apple is a fabulously successful company and often exhibit A for this. Tell the story, if you would, from the perspective of that company.
Okay, so because Apple is largely an intellectual property company, it is able to have most of the licenses for its technology owned by its foreign subsidiaries. And so then the use of those patents by its various operations globally generates royalty payments to its subsidiary in Ireland. And that's the mechanism by which they're able to take a lot of their global income and locate it for tax purposes in Ireland. And then they engage in some other transactions involving other countries and other entities and are able to nearly eliminate their contemporaneous income tax, corporate income tax that would be payable if instead those operations had been located in the United States.
And I thought they were great technology innovators, and at the same time they turn out to be great finance innovators.
They, as you mentioned before, are one of the leading companies engaging in these types of transactions. I don't know how much of it is generated internally versus having very good accountants, but yes, they've...
Well, let me boil it down to this. If I buy an iPad or somebody buys an iPad and say it's $500 and say there's $100 in profit, there's probably $200 for Apple, that money doesn't get taxed to the degree that the U.S. tax authorities would like.
So most certainly if that sale took place in a foreign country, almost certainly the bulk of that profit would have been realized by their Ireland subsidiary and therefore not yet subject to U.S. taxes, because the way the U.S. tax code works is that if you have earnings over in a foreign subsidiary, the U.S. does not tax it until it actually comes back to the United States through a process called repatriation. And so that delay in the payment, or the delay in bringing the money back to the United States, not only does it delay taxes, but then Apple has to do something with the money in the interim, and that's what gives rise to these large cash balances that we're observing by the companies that are able to successfully engage in these tax transactions.
So we read that there are trillions of dollars parked overseas that could be brought home to help stimulate our economy and generate tax revenue for the government, but that the companies have them sitting in Ireland for some reason. And you say there's a bit of a misconception there.
Right. So for tax and legal purposes, they are controlled by the foreign subsidiaries. But in terms of where the money's actually located, it's not as if it's sitting in an Ireland bank, nor is it sitting in the Irish capital markets. It's in the US capital markets. So generally what happens is that the Ireland subsidiary has some kind of banking relationship where they deposit the money, possibly through a US bank's foreign affiliate in Ireland. Those monies are then invested in the US stock market or the US bond market. And so that money is, for all intents and purposes from an economic standpoint, in the United States. So starting in, I believe, 2012, the Securities and Exchange Commission mandated that firms begin disclosing not only where their cash is located, but also the types of investments. And so you can actually go onto the Securities and Exchange Commission's website, and you'll see in the more recent annual filings that a significant portion of the money is actually in US Treasuries, including by Apple. And so if we were to declare a repatriation tax holiday, much like the one that was done in 2004, what Apple would do is liquidate its US Treasuries, either invest the money or more likely pay it out to its investors, or in Apple's case, pay off some of the debt that it has incurred. But then those monies would just go out of the U.S. capital markets, i.e. treasuries, back into the U.S. capital markets via these dividend payments or these payoffs of these outstanding bonds, and it's a wash. In the process, the U.S. government does take in whatever percentage they have on it.
So what, if anything, should be done here?
What this really calls for is overall corporate tax reform, is to reduce the incentive for U.S. companies to locate their operations in foreign subsidiaries in the first place. It's not long-term viable for us to have the highest corporate income tax rate amongst OECD nations. And even though effective rates are lower, the reason that effective rates are so much lower is because firms are engaging in these types of transactions and they do create distortions. So overall, what's needed is a significant reduction in the corporate income tax rate so that firms have more of an incentive to locate operations here and not play these games with their foreign earnings.
Very good. Mike Faulkender of the Robert H. Smith School of Business. Dr. Faulkender, thank you for being with us.
Thank you for having me.